Hi everybody, welcome back to another video. So in this video, I will go through the Mapletree Infrastructure Trust full year 2023 earnings and also share on the risks and rewards that can be observed. Moreover, I will also share valuable information that has been observed from their earnings call. Before we start, it would be good if you could hit the like, subscribe and comment on any analysis that you would like me to work on next. Like many REITs, MIT is not immune to the interest rate hikes and the macroeconomics environment. For MIT, based on the recent results, they also experienced a drop in the DPU, but this was partially or mostly due to the enlarged unit base based on their DRP program that was given out for the past 5 years, which means that shareholders can opt for units instead of cash. Good news is that they have stopped it and they have a healthy balance sheet with enough funds for any potential acquisition or development project based on the management speech. So let us take a look at their key highlights. So for the key highlights, net property income and the distributable income increased year over year as expected due to additional assets. However, their DPU still dropped mostly due to enlarged units. And another thing that is affecting it is most probably due to the cost of debt rising. So the redevelopment of the Kallang Way have finally been completed and they are actually contributing or starting to contribute with an initial occupancy of 44.1%, which is quite impressive. And in the earnings call, the management had mentioned that they will be aiming for 75% by the end of this year or two if possible. So this will be an additional income or a good plus sign in the upcoming few quarters. So we will have to take a look and see the improvement in the occupancy. So for the property valuations in the portfolio performance, although there are not much information here, there is a lot of things to know from this 0.1% raise year over year. So firstly, the management have mentioned that the US data centers, it went up slightly due to rental escalations and strong demand from tier 1 places, growing faster than the interest rate, which is a very good thing because this actually meant that if the interest rate drops, their data centers would actually improve in terms of the capitalization rate and thus giving shareholders more income. But for Singapore properties, it declined due to shorter tenants and government policies. So shortening of tenancy leases tend to affect valuations. However, another interesting thing that is actually affecting is the government policies, where they are implemented higher stamp duties, which would definitely affect the valuations. The drop in valuations was looking minimal due to new contribution from the Kallang new high-tech building. Therefore, overall Singapore properties valuation did not drop that much. Overall occupancy slightly dropped to 94.9% due to the inclusion of the high-tech building with an occupancy of only 44.1%. So excluding this new high-end tech property, the overall occupancy would have been up. So for capital management wise, they are at a healthy level of 37.4% leverage ratio because this was helped due to the DRP raise throughout the 5 quarters and ensuring that they have a strong balance sheet. The good thing is that the management have ensured that this balance sheet is good enough for the future fund development projects and having a stronger balance to mitigate any bad macroeconomics. So from their distributable income, it does not look good and the management has actually given a cautious outlook for this upcoming new financial year, and they have mentioned that it might be a difficult year as well. So we have to see from the performance, and hopefully if the interest rate comes down, they will benefit from it and this will indirectly help us to increase the distributable income and the DPU. So looking at their results, gross revenue has been little or no change quarter over quarter, and hopefully we could see it improve with the new leases of the high-tech building, which is the Kallang Way assets, providing or contributing to their revenue soon. Operating expenses increases 1.3% quarter over quarter, while the year over year for the Q4 was 5.8% due to higher inflation and utility expenses. On the bright side, they are managing well if the growth rate is actually decreasing, as the year over year was 5.8, while the quarter over quarter was only 1.3%. So we'll have to continue monitoring, and hopefully it drops or the revenue actually grows faster than the expenses. For those who are new to reading the REIT's balance sheet, please do not be alarmed if you see profits before tax to be at such a low level and decreasing 86.9%. This is due to book valuation drop in their properties, therefore they have to be accounted as a booking loss. That's why for REITs, it's important to always look at their distributable income, which can be seen here, where their DPU actually, or their distributable income actually dropped by 1.4% quarter over quarter, whereas for their DPU actually only dropped by 1.8%. So for the DPU wise, please take note that it includes a tax exemption of 2.2 million and a 1.96 million of divestment gain, as you can see here, where each different additional distribution was given, and they will end at the first quarter of financial year 23 and 24, which means that the next quarter would be the last additional distribution. So without this, it actually equates to about 4.16 million, and therefore 4.8% of this quarter's distributable income. Therefore, this is a risk that without these additional incomes, MIT DPU might continue to drop in the subsequent quarters once these two additional gains are not taken into effect. So therefore, in investment, it's important to take into account all these small risks and rewards. Looking at their debts, they have a very healthy leverage ratio of 37.4%, and the management have mentioned in the earnings call that they aim to be in the area of about 40 to 45% leverage ratio for the upcoming future of growth. Good thing is that they do not have much financing required to do in the next 2 years, as you can see, where the full year of 23 and 24 and 24 and 25 only have about 10% of the debts required to be refinanced. Thus, they have mentioned that this will ensure that their cost of debt would not have a sharp increase as compared to the past year. Concern was raised during the call if the high leverage ratio will affect the investors' confidence and their Fitch ratios of BBB+. Management have gave a reasonable response, saying that they have a healthy interest coverage ratio, and it will be dependent on the investors' response as they act. This meant that even though they have a goal of having a comfortable range of 40 to 45% leverage ratio, actually the investors have the final say, as the management would listen to opinions. So this is a good indication as the management are willing to listen to investors. Next, let us look at their properties composition. As you can see, most of the properties are accountable in data centers with 53.7%. Next will be the high-tech buildings at 17.3%. So the management have set a long-term goal of having data centers at 75% in the future. But to achieve that 75% will not come so soon due to high interest rate, as mentioned by the management in the earnings call. Even for the 50% stake of the current USDC properties, they will only acquire when the interest rate is at a favorable level to loan. With the borrowing costs too near to the property's capitalization rate, it's not visible to acquire it now because there will be no accretive to shareholders or to the REITs itself. For the occupancy, overall has decreased, as I mentioned just now, from 95.7% to 94.9%. However, this was due to the inclusion of the new asset, which has a occupancy rate of just 40+%. As you can see, this is expected where the high-tech building has dropped from 94.8 to 87.5%. Whereas for the other properties, there are actually not much changes. However, if we exclude this drop, it will have been an increase overall. However, what I want to focus on is the tenancy lease expiry, which you can see for the next few years, there are quite a lot of expiries that are a concern. In the earnings call, they mentioned that while a lot of all these expiry are small tenants, one of the big tenants to focus on is AT&T. AT&T being the 5.4% overall income as rentals expiry at 23 and 24 respectively, which equates to financial year of 23-24 and 24 and 25. Considering they are not doing so well, this might be a risk with large income of this required to be replaced. So throughout the earnings call, the management are actively talking to potential users and prospects of new tenants. They also shared interesting things such as finding single users for the whole building so that it's easier to manage, rather than having a multi-users building which is essentially co-location assets. If new tenants is required, downtime might be a long of 6 to 9 months in order to find the right tenants, as finding the right tenants is not as easy as it seems. Therefore, the management is trying to minimize constant changing of tenants. The management have also shared some additional challenges that the data center tenancy are facing. Firstly, MNCs have bigger power and attractiveness from other REITs as well, thus giving them more options or more of the seller's power in order to negotiate better rentals. Secondly, higher interest rate and uncertainty environment have caused customers to be more stringent with their spendings. And lastly, REITs have to give incentives in order to attract the tenants to stay, as this is currently a tenants market. So looking at the rental reversion and the occupancy, although the occupancy has dropped, the rental reversion is still at a healthy, with trending up slightly from $2.15 to $2.60. So hopefully once the occupancy recovers, it will actually bring up or give a better distributable income for shareholders. So focusing on the Q4 rental reversions, notice that for the high-tech buildings, there is a large drop in the new leases that is coming in. So in the call, they have mentioned that this was due to the new asset, which is the Kallang Way asset. Since high-tech buildings have a mixture of different attribute buildings, this also means that they will attract different customers at different rates. So because of this large category, therefore this has caused a large difference in the rentals, and it might look very underdetermining as compared to the other new high-tech buildings that are giving higher rental reversions. Good news is that they have mentioned that for the new asset, they have been increased in viewings and inquiries since April of 23, when the asset was built finished in Q1. And these most of the tenants are from electronics, biolabs, and the IT sectors. Questions have also been asked with regards to the renewal of the drop in the rentals. Due to tight competition, the management have said that the renewal of the large tenants was given with incentives. However, they have mentioned that the good thing is that it's still higher than the market or the passing rate rentals. The other categories are doing decent in this environment with strong competition. It is important that REITs are big and strong enough to ensure that tenants do not take advantage and ask for more incentives. In the earnings call, they have also given additional pointers that I will be summarizing. So, firstly, they have talked about redeveloping of different asset class into more valuable classes, such as the Kallang Way high-tech building asset example. So, we might see more divestment or acquisition in different targeted sectors. Secondly, geographically wise, they have also talked about expanding into different countries rather than just focus on United States and Singapore, with European markets and Asian markets of data centers being the main focus and a very long-term goal of 75% assets data center composition. With a lot of assets having a capitalization rate of around 4%, Asian markets looks a bit more interesting as compared to Europe and US market due to higher borrowing costs. So in the next 2 years, depending on the economy, we might see a 1 or 2 potential acquisitions with regards to data centers. However, they are also not ruling out the facts into looking into high-tech buildings, R&D buildings, or biotech buildings, which are highly rental reversion buildings. Lastly, they would rather do asset acquisitions rather than asset enhancement, because they would rather not have to make up for the loss in the floor space during the enhancement process, but rather just having acquisition would allow them to continue to make full use of their other assets. So in conclusion, MIT has many risks and potential improvements in incomes, but we'll have to see how they manage the upcoming changes that might occur. So what are the risks involved in MIT? Firstly, losing AT&T as tenants and taking too long to find replacement. This would cause occupancy to drop, and obviously distributable income and DPU would drop as well. Therefore, this will give lower yield back to investors. Secondly, Kallang Wave or the new asset income do not contribute as fast as desired and will result in overall DPU drop due to the exclusion of the additional income that have been given in the distribution so far. Lastly, rentals go down due to renewal reversions as more incentives have to be given due to strong competition. However, there are also rewards as well. Firstly, occupancy goes up more than expected and the new asset does surprisingly well. And secondly, they would settle their AT&T expiry income and able to provide better DPUs throughout the year. And this will actually definitely help the REIT as well. In my opinion, at 5% of the overall rental income is honestly quite okay as compared to some REITs which had major tenants at 20% income and above. So this case actually shows the importance of finding diversified tenants to spread out the income, therefore not depending on one. Of course, investing at times when people are fearful are definitely able to give better returns in the long run. Thank you so much for watching. I hope that this video actually brings light to MIT's recent performance. Please hit the like, subscribe, and comment on any analysis that you would like me to work on next. Thank you, and to the next video.